Once again, we have another policy designed by civil servants sipping lattes in that rather agreeable ground floor coffee shop at One Horse Guards Road, safe in the knowledge that their regular monthly salary, their generous taxpayer-funded pensions and their ability to work from home a couple of days a week provides that comfortable lens through which they work and view the world outside. But outside in the real world, we have whole armies of people who don't do the 9 to 5. They live by their wits, they're self-employed, they undertake seasonal work, term-time employment. The man or woman for whom the Labour Party was established and who salt money away for their retirement when they can. Many of these work hard and ask their accountant to do their books at the end of the year. It might take some time. Neither the worker nor the accountant work to strict 12-month timescales. It might take 3 months to finalise the numbers in 1 year, 9 months the next. That's the untidy way in which the real world works. So to legislate, to confiscate someone's pension after 12 months as it was fly-tipped by the side of the road to be swept into the dumpster of some poor performing default scheme amounts to theft and an abuse of trust that undermines confidence in the pension system itself. I totally endorse Amendment 49 in the name of my noble friend Baroness Altman for another reason as well. Throughout the entirety of the canon of pensions legislation, we have a 3-year carryback where people can make up their pension deficit over 3 years, and this is entirely consistent with that, and consistency, simplicity and understandability are the watchwords with which we should proceed.
My Lords, I also support my noble friend Baroness Altman in her amendments, whether she chose...
My Lords, those people who've done the right thing and saved for a retirement have made a bargain with the state. In exchange for a little help on the way in, the state will be relied on a little bit less on the way out. That's the deal. And the responsibility of finding people to look after your money lies with the individual and the trustee or investment managers they appoint. On that simple truth, London has developed global leadership in asset and investment management, and the entire city ecosystem has created a tax gusher that pays for defence, schools and hospitals. We should not place it or its reputation under threat. And we've heard a lot from the dispatch box over the last 12 months or so about the sort of investments that government thinks we should invest in, and we need to learn some lessons from history. Green schemes, forgetting that when they tried this under political direction in Sweden, it created the $5.8 billion Northvolt disaster, and all the public sector pensioners lost their shirts. The Minister from the dispatch box lionised the large Canadian public sector schemes as the model that should be followed. Last year, their investment returns went down by 5% at the same time as our own LGPS went up by 9%. Ministers want schemes to backfill UK infrastructure, perhaps steel, which we now learn has cost us over £1 billion in little over a year, money that will be never seen again. Carbon storage, passive funds, which by arithmetic lead you into bubbles or into high-risk private assets, where at 5 o'clock this morning, the Financial Times published an excoriating demolition of the claims that private equity funds do as well as the Chancellor claims, especially as the J-curve gets stretched out beyond 10 years. I could go on, I won't. The point is that whilst ministers want to pick winners, they've been selling lemons. The pound shop pundits are trying to force-feed the most risky parts of the market, the bits the other professionals turn their noses up or consider they're not right for the man in the street, down the throats of those for whom taking excessive risk is not necessarily the right thing. The government's job is to create the environment for the best and most attractive investment ideas to come forward, not to beat pensioners with a stick and strong-arm them into financing their high-risk pet projects with high fees and uncertain returns. But worst of all, if mandation does come, it will create this sort of value-sapping moral hazards and conflicts of interests that will allow the most poorly performing managers to get a get-out-of-jail-free card. It was that Torsten Bell chap what told me what to do it. Gov. Whilst trashing the global reputation of the UK asset management business and imperiling that tax gusher we all rely on. But ultimately, it'll be the little guy who pays the price. Poorer, long after Rachel Reeves and Torsten Bell have become a footnote in history. It's our duty to stop this, and we must.
My Lords.
Obsession with size, but everyone knows it's not about size, it's what you do with it. And that point was made forcefully in the Financial Times this morning when discussing the fact that the larger funds aren't necessarily better performers, with the subheadline, "Seeking size for its own sake can distract fund managers from focusing on clients and shareholders." There is so much I can say, but I'm going to restrict myself to one substantive point. When schemes get large, their normal market investment size gets bigger too. They don't have the time, capacity or need to go away from the big global stocks, most of which are, by their nature, overseas. It limits the constellation of investment ideas, so they chase the same MSCI stocks, creating a value-destroying bubble and systemic risks by all chasing the same thing. It becomes all about speculation. But that's not what capital markets are necessarily for. Capital markets exist to provide capital so that smaller companies can become big ones. And right now in the UK, there are lots of smaller companies with bright ideas and great prospects that could become bigger if only they were relevant to the funds. A few million here, perhaps a few tens of millions there. But they are all but invisible to the super funds, for whom anything less than half a bar is a rounding error. And the problem is for the UK, that whilst ministers are worshipping the false icons of scale, they will actually make it harder for the stock market to invest in small British businesses at home. If the schemes are forced to bulk up, they simply won't have the time to look for or after the small fry. So British companies who are crying out for long-term patient capital will go hungry, and that directly contradicts the Mansion House objectives. Once again, the government has been suckered into a position by the big boys, understandably keen to cut out the competition, and is visiting harm on the UK economy, and especially the small British firms we all want to see do well. As the Financial Times says today, a substantial body of evidence in academic research suggests that mergers in financial services frequently lead to prolonged periods of underperformance, revenue synergies fail to materialise, and cost synergies tend to be overstated. Quite.
In favour of Amendment 55 in the name of the Noble Baroness Noakes. There is a questionable theory of change.